When you receive your paycheck, you might notice a significant difference between the amount you see listed as your salary and what actually lands in your bank account. This discrepancy is a common source of confusion, and it all boils down to two key terms: gross income and net income. Gross income is the total amount of money you earn before any deductions. This includes your salary, bonuses, and any other earnings. It's the figure that looks impressive on paper, but it doesn't tell the whole story. Now, let's talk about net income. This is the amount you take home after taxes and other deductions are subtracted from your gross income. Think of it as your actual earnings, the money you can spend, save, or invest. Understanding this difference is crucial because it directly impacts your budgeting and financial planning. Why does this matter? Well, knowing your net income helps you make informed decisions about your spending and saving. If you only focus on your gross income, you might overestimate your financial capacity and end up in a tight spot when bills come due. Let's break it down with a real-life example. Imagine you have a gross income of $5,000 a month. Sounds great, right? But after federal and state taxes, Social Security, and health insurance deductions, your net income might only be around $1,800. That's a difference of $12,200. Understanding this gap allows you to plan your expenses more realistically. Now, here's a tip. Always calculate your net income when creating a budget. Start with your gross income, then subtract all mandatory deductions. This will give you a clearer picture of what you can actually spend. Additionally, consider setting aside a portion of your net income for savings and investments. This way, you're not just living paycheck to paycheck, but actively working towards your financial goals. To help you with this, there are simple tools available online that can assist you in calculating your net income after taxes and deductions. These calculators can provide a quick estimate based on your gross income and local tax rates, making it easier to plan your finances. Understanding the difference between gross and net income is essential for anyone looking to manage their finances effectively. By grasping these concepts, you'll be better equipped to make sound financial decisions and achieve your financial goals.
Gross income is a term that often gets thrown around, but what does it really mean? Simply put, gross income is your total earnings before any deductions. It's the sum of everything you've earned from various sources. Think about it. Your salary or hourly wages, bonuses, commissions, freelance gigs, side hustles, rental income, and even returns from investments. All of these contribute to your gross income. Imagine you're working a full-time job and earning hours 500,000 a year. That figure right there is your gross income. It's what you see on paper before any taxes, insurance, or other deductions are taken out. It's crucial to understand this because it gives you a clear picture of your financial standing before the government and other entities take their share. Now, let's break it down a bit more. If you're a freelancer, your gross income is the total amount you earn from all your projects. Whether you're designing websites, writing articles, or consulting, every rupee you make counts towards your gross income. It's essential to keep track of all these earnings because they contribute to your overall financial health. And what about bonuses and commissions? If you're in sales, those extra earnings can significantly boost your gross income. They're not just a nice addition, they can change your financial landscape. So when you receive that bonus, remember, it's part of your gross income. Now let's not forget about rental income. If you own property and rent it out, the money you receive from tenants adds to your gross income. This is an excellent way to diversify your earnings and build wealth over time. For businesses, gross income works a bit differently. It's calculated as the revenue earned minus the cost of goods sold, or COGS. This means that if a business sells products, the gross income reflects the money made from sales after accounting for the costs directly associated with producing those goods. Understanding this helps businesses gauge their profitability before considering other expenses like salaries, rent, and utilities. So, whether you're an individual or a business owner, grasping the concept of gross income is vital. It's your financial foundation, the starting point for budgeting, saving, and planning for the future. Knowing your gross income empowers you to make informed decisions about your finances. In summary, gross income is not just a number, it's a reflection of your hard work and various income streams. Keep track of it, understand it, and use it to your advantage. It's the first step towards achieving your financial goals and ensuring a secure future. Net income is a term that often gets thrown around, but what does it really mean? Simply put, net income is the amount of money you actually take home after all the deductions have been made. It's the figure that truly reflects what you can spend, save, or invest. Let's break it down. Imagine your gross monthly income is Rs 50,000. Sounds good, right? But then you have to consider the deductions. These can include taxes like income tax and professional tax, insurance premiums, retirement contributions such as EPF or NPS, and even loan EMIs or other direct debits. When you add all these deductions together, let's say they total Rs 10,000. That brings your net income down to Rs 40,000. Now this Rs 40,000 is your spendable money. It's what hits your bank account at the end of the month. Understanding your net income is crucial for budgeting. It helps you plan your expenses, set financial goals, and even decide how much you can save or invest. Think about it. If you're not aware of your net income, you might end up overspending. You could be living in a bubble, thinking you have more money than you actually do. This can lead to financial stress, especially if unexpected expenses come up. Let's say you want to buy a new gadget or plan a vacation. If you know your net income, you can make informed decisions. You can set aside a portion for savings, allocate some for entertainment, and still have enough left for your essential expenses. It's also important to keep track of your deductions. Sometimes people overlook certain deductions that can significantly impact their net income. For instance, if you're contributing to a retirement fund, that's money you won't see in your net income right now, but it's an investment in your future. So when you check your bank balance and see your net income, remember that it's not just a number. It's a reflection of your financial health. It tells you how much you can realistically spend without jeopardizing your savings or future goals. In summary, net income is your financial reality. It's the difference between your gross income and all those deductions. Understanding this concept is essential for effective budgeting and achieving your financial aspirations. So the next time you look at your paycheck, remember to do the math. Gross income minus deductions equals net income. That's the number that truly matters.
When we talk about income, it's essential to understand the key differences between gross and net income. Let's break it down. First, think of gross income as the total amount you earn before any deductions. This is the figure you see on your job offer or paycheck. It's the big number that looks impressive, but it's not the amount you actually take home. Now, net income is what you can actually use, the money that ends up in your bank account after all those deductions. Now, let's dive into the impact of deductions. Deductions like taxes, insurance premiums, and retirement contributions are taken out of your gross income. These deductions can significantly reduce your take-home pay. For example, if your gross income is $60,000 a year after taxes and other deductions, your net income might be closer to $45,000. That's a big difference. Understanding these figures is crucial for financial planning. Gross income is useful when evaluating job offers. It helps you see your earning potential and compare different opportunities. But when it comes to creating a budget or savings plan, net income is your best friend. It's the real number that dictates how much you can spend, save, or invest each month. Knowing both gross and net income is vital, especially when negotiating salaries. You want to ensure that the offer you're considering aligns with your financial goals. If you're applying for loans or mortgages, lenders will look at your net income to determine how much you can afford to borrow. They want to see your actual take-home pay, not just the gross figure. Let's visualize this with an example. Imagine you receive a job offer with a gross income of $70,000. After federal and state taxes, health insurance, and retirement contributions, your net income might be around $52,000. That's the number you'll use to plan your monthly budget. Now, picture a timeline showing how those deductions work. You start with your gross income, and as each deduction is applied, you see the number shrink until you reach your net income. It's a clear visual of how much money you actually get to keep. In summary, gross income is the total amount you earn, while net income is what you actually take home. Both are important for different reasons. Gross income helps you evaluate job offers, while net income is crucial for budgeting and financial planning. Understanding these differences empowers you to make informed financial decisions.
When I received my job offer, I was thrilled. The salary was impressive. Let's say it was 10 lakh per annum. But then I took a closer look at the offer letter, and that's when the reality hit me. The gross income sounded great, but I needed to understand my net income. So I sat down with a calculator and started breaking it down. First, there were the mandatory deductions, income tax, provident fund, and professional tax. After all those deductions, my net income came down to about 7.5 lakh. That's a significant difference. It made me realize how important it is to look beyond the gross figure. Now, let's compare this with my friend who decided to go freelance. He was excited about the flexibility and the potential to earn more. He landed a project that paid him 1 lakh for a month's work. Sounds fantastic, right? But he quickly learned that as a freelancer, he had to manage his own taxes and set aside money for health insurance and retirement savings. After accounting for all those expenses, his take home was closer to 70,000. This made me think about budgeting. With my net income of 7.5 lakh, I had to plan my expenses wisely. I started by listing my fixed costs: rent, utilities, groceries. Then I allocated a portion for savings and investments. I realized that budgeting isn't just about tracking what you spend, it's about making informed decisions based on your net income. I also learned the importance of benefits. My job offered health insurance and a provident fund contribution, which added value to my overall compensation. In contrast, my friend had to pay for his health insurance out of pocket, which cut into his freelance earnings. So, when comparing job offers or freelance opportunities, it's crucial to consider the entire package: gross salary, net income, benefits, and potential expenses. It's not just about the number on the paycheck, it's about what you actually take home and how you manage it. In the end, whether you're in a full-time job or freelancing, understanding the difference between gross and net income can make a significant impact on your financial health. It's all about being informed and making choices that align with your goals.
Calculating net income is essential for understanding your financial health. It's a straightforward process, and I'm going to break it down for you. The formula is simple. Net income equals gross income minus deductions. Let's start with gross income. This is the total amount you earn before any deductions. It includes your salary, bonuses, and any other income sources. Now, to find your net income, you need to subtract your deductions from this total. So, what are these deductions? First up is income tax. In India, for instance, the tax slab you fall under will determine how much you owe. It's crucial to check the latest tax rates because they can change. Next, we have EPF contributions. Typically, this is 12% of your salary. This is a mandatory savings scheme for employees in India aimed at providing financial security after retirement. It's a deduction that you should factor in because it directly impacts your take-home pay. Then there are health insurance premiums. These can vary widely depending on your coverage, but they're an important deduction to consider. Having health insurance is vital, and while it reduces your net income, it's an investment in your well-being. Another deduction to keep in mind is professional tax. This varies by state, so it's worth checking your local regulations. It's a small amount, but it adds up, and you don't want any surprises when you're calculating your net income. Now, let's put this into practice. Imagine you have a gross income of $5,000. If your income tax is $800, your EPF contribution is $600. Your health insurance premium is $200, and your professional tax is $100. You'd calculate your net income like this: $5,000, gross income, $800, income tax, $600, EPF contribution, $200, health insurance, $100, professional tax equals $3,300, net income. That's your take-home pay. If you're not keen on doing this manually, there are tools available that can simplify the process. Online salary calculators can be a lifesaver. Apps like Walnut or Money Control allow you to input your gross income and automatically calculate your net income, factoring in all those deductions. Using these tools can save you time and ensure accuracy, especially if you have multiple income sources or varying deductions. Just remember to keep your information updated, as changes in your salary or deductions can affect your net income. Understanding your net income is crucial for budgeting and planning your finances. It gives you a clear picture of what you can spend, save, or invest. So, take the time to calculate it accurately, and you'll be better equipped to manage your money effectively.
Managing your net income effectively can feel like a juggling act, but with the right strategies, it becomes much easier. Let's dive into some practical tips that can help you take control of your finances. First up, creating a budget is essential. I recommend using the 50-30-20 rule. This means allocating 50% of your income to needs. Think rent, groceries, and utilities. Next, 30% should go to wants, those fun things like dining out or that new gadget you've been eyeing. Finally, the remaining 20% should be directed towards savings. This simple framework can help you maintain a balanced financial life. Now, let's talk about planning for deductions. It's crucial to account for any deductions when you're mapping out your financial plans. Whether it's taxes or retirement contributions, knowing what will be taken out of your net income helps you avoid surprises and ensures you're not living beyond your means. Building an emergency fund is another key strategy. Life is unpredictable, and unexpected expenses can pop up at any moment. By setting aside a portion of your net income for emergencies, you'll have a safety net to fall back on. Aim for 3 to 6 months' worth of living expenses. This fund can provide peace of mind and keep you from going into debt when life throws a curveball. Tracking your expenses is also vital. In today's digital age, there are countless apps available that can help you monitor your spending. By keeping an eye on where your money goes, you can identify areas where you might be overspending and make adjustments accordingly. It's all about staying within your means and making informed financial decisions. Lastly, let's discuss investing wisely. It's important to allocate a portion of your net income to growth-oriented investments. Whether it's stocks, bonds, or mutual funds, investing can help your money work for you over time. Start small if you need to, but the earlier you begin, the more you can benefit from compound interest. By implementing these tips, creating a budget, planning for deductions, building an emergency fund, tracking your expenses, and investing wisely, you can manage your net income more effectively. It's all about making informed choices and taking proactive steps towards financial stability. Remember, every little bit helps, and with consistency, you'll see the results over time.
Gross income and net income are terms that often get tossed around, but there are some common misconceptions that can really trip people up. Let's dive into a few of these myths and clear the air. First up, the idea that gross income is the same as take-home pay. This is false. Gross income is what you earn before any deductions, while take-home pay is what actually lands in your bank account after taxes, retirement contributions, and other deductions. If you're not accounting for these deductions, you might be in for a rude awakening when you see your paycheck. It's crucial to understand that just because you earn a certain amount doesn't mean you'll see all of it. Next, let's tackle the belief that a higher gross income automatically leads to a higher net income. This isn't always the case. Sure, earning more sounds great, but it can also push you into a higher tax bracket. That means you could end up paying a larger percentage of your income in taxes, which can eat into your net income significantly. It's essential to look at the bigger picture and understand how taxes work, rather than just focusing on that gross number. Now, let's talk about deductions. Some people think that deductions are a bad thing, but that's a misconception too. Deductions like contributions to your employee provident fund or insurance premiums are actually investments in your future. They might reduce your immediate take-home pay, but they're helping you save for retirement or protect yourself against unforeseen circumstances. Embracing these deductions can lead to greater financial security down the line. Understanding these misconceptions is vital for making informed financial decisions. By knowing the difference between gross and net income, recognizing the impact of taxes, and appreciating the value of deductions, you can navigate your finances more effectively. This knowledge empowers you to plan better, save smarter, and ultimately achieve your financial goals. So, take a moment to reflect on these points and ensure you're making the most of your income. Understanding the difference between gross and net income is essential for anyone looking to take control of their finances. Let's break it down. Gross income is the total amount of money you earn before any deductions. This includes your salary, bonuses, and any other income sources. It's the big number that looks great on paper, but it's not the amount you actually take home. Now, net income is where the rubber meets the road. This is the money that ends up in your bank account after taxes, retirement contributions, health insurance, and other deductions are taken out. It's the real picture of what you have to work with for your monthly expenses, savings, and investments. Why does this matter? Well, understanding these two figures can significantly impact your financial planning. For starters, when you're budgeting, you need to base your expenses on your net income, not your gross. If you're only looking at your gross income, You might find yourself in a tight spot when bills come due. Evaluating job offers is another area where this knowledge is crucial. When you receive a job offer, it's tempting to focus solely on the gross salary. But if you don't consider the net income, you could end up accepting a position that pays well on paper, but leaves you with less than you expected after deductions. Always ask about the benefits and deductions to get a clearer picture of your take-home pay. Planning for the future is also tied to understanding these concepts. If you're saving for retirement or a big purchase, knowing your net income helps you set realistic savings goals. You can't save what you don't have, so having a clear understanding of your net income allows you to allocate funds appropriately. In summary, gross income is what you earn, but net income is what you keep. This distinction is vital for effective budgeting, evaluating job offers, and planning for your financial future. So, what's one thing you learned about gross and net income today? Let's chat below.